Hey everyone, so you're thinking about moving to Spain? That's awesome. But before you pack your bags, it's really important to understand how taxes work here. Knowing if Spain sees you as a tax resident is a big deal. It decides what taxes you pay and how much money gets taken out. If you don't get this right, you might have to pay a lot more than you expected. So let's break down what tax residency means in Spain. It's super important for anyone living, working, or even just investing here. Knowing your tax status helps you manage your money better and keeps you on the right side of the law. This way you can enjoy your new life in Spain without any tax surprises. Whether you're retiring on a sunny beach or starting a cool new business, knowing your tax situation is key. Okay, so how do you know if Spain considers you a resident for taxes? This is a crucial question for anyone spending significant time in the country, whether for work, leisure, or family reasons. The simplest rule is the 183-day rule. This means that if you spend more than half the year, specifically 183 days or more in Spain, you are generally considered a tax resident. If you spend more than 183 days in Spain during a year, you're usually considered a tax resident. This includes not just continuous days, but also cumulative days throughout the year. Don't worry, these days don't have to be all in a row. You can come and go as you please, and all the days you spend in Spain will be added up. Even short trips outside Spain still count towards the 183 days. So if you take a weekend trip to France or Portugal, those days still contribute to your total. But it's not just about how many days you're here. Spain also considers other factors to determine your residency status. Spain also looks at your money and family. If you have significant economic interests in Spain, such as owning a business or earning most of your income here, you might be considered a tax resident. If most of your income comes from Spain or your business is here, you might be a tax resident, even if you spend less than 183 days in the country. This is because your economic ties to Spain are strong. Same goes for family. If your spouse and kids live in Spain, and you're not officially a tax resident somewhere else, Spain might consider you one of their own. If your spouse and kids live in Spain, and you're not officially a tax resident somewhere else, Spain might consider you one of their own, even if you're here for less than 183 days. Family ties are a strong indicator of residency. Remember, everyone's situation is different. The rules can be complex and various factors come into play. The Spanish tax authorities look at everything to decide your residency status. It's always a good idea to consult with a tax advisor to understand your specific situation and ensure you're meeting all the requirements. So we talked about the 183-day rule and family money ties, but there are some exceptions. These exceptions can significantly impact how much tax you end up paying and where you pay it. Understanding these nuances is crucial for anyone planning to live or work abroad, especially in a country like Spain. Double taxation treaties stop you from paying taxes twice on the same money in two different countries. These treaties are agreements between two countries that determine which country has the right to tax certain types of income. They are designed to promote international trade and investment by eliminating the risk of double taxation. Spain has these agreements with lots of other countries. This means if you're earning income in Spain but are a resident of another country with a tax treaty, you won't be taxed twice. These treaties cover various types of income, including salaries, pensions, and business profits. They decide which country gets to tax your income. The specific rules can vary depending on the treaty, but generally, the country where the income is earned has the primary right to tax it. The other country may provide a tax credit or exemption to avoid double taxation. Another important exception is the Beckham Law. This law was named after the famous footballer David Beckham, who benefited from it when he moved to Spain to play for Real Madrid. It's officially called the Special Regime for Impatriate Workers, but Beckham Law is way easier to remember, right? This law was introduced to attract highly skilled professionals and foreign investment to Spain. This law gives big tax breaks to foreigners moving to Spain for work. It allows them to be taxed at a flat rate of 24% on their Spanish income, rather than the progressive rates that can go up to 45%. With the Beckham Law, you can choose to be taxed as a non-resident for 6 years. This means you only pay taxes on money you earn in Spain, which can save you a bunch, but there are rules. This means you only pay taxes on money you earn in Spain, which can save you a bunch, but there are rules. For instance, you can't have been a tax resident in Spain for 10 years before moving here, and you need to work for a Spanish company or be sent here by a foreign company. Additionally, the law is aimed at high-income earners, so there are income thresholds that must be met to qualify. You can't have been a tax resident in Spain for 10 years before moving here, and you need to work for a Spanish company or be sent here by a foreign company. Understanding these rules and planning accordingly can make a significant difference in your tax liability and overall financial planning when moving to Spain. Section 4. Tax responsibilities for residents and non-residents. Understanding your tax obligations is crucial whether you're a resident or a non-resident. This section will guide you through the key differences and what you need to know to stay compliant. What you owe in taxes depends a lot on whether you're a resident or not. The distinction between resident and non-resident status can significantly impact your tax liabilities and the forms you need to fill out. If you're a resident, you pay taxes on all the money you make everywhere in the world. This means that your global income, including earnings from foreign investments, must be declared and taxed in Spain. This goes to Spanish income tax. Residents are required to file annual tax returns detailing all sources of income, both domestic and international. The more you earn, the higher the tax rate. Spain uses a progressive tax system, meaning that higher income brackets are taxed at higher rates, which can significantly affect your overall tax bill. If you're a non-resident, you only pay taxes on money you make in Spain, like from a job, renting out a place, or selling something valuable. Non-residents are not taxed on their global income, only on income generated within Spain. Non-residents usually have a simpler tax rate, but remember, you might still owe taxes in your home country. It's important to check the tax treaties between Spain and your home country to avoid double taxation. Besides income tax, both residents and non-residents might have to pay other taxes in Spain, like wealth tax if you own a lot of stuff. Wealth tax is levied on the net value of your assets, including properties, investments, and luxury items. And property tax if you own a house or apartment. Property tax is an annual tax based on the value of your real estate holdings in Spain. Knowing the rules for your situation is super important for staying out of trouble with the tax authorities. Make sure to consult with a tax advisor to understand your specific obligations and to ensure that you are fully compliant with Spanish tax laws. Section 5. Capital gains tax in Spain. Capital gains tax is the tax you pay when you sell something valuable, like a house or investments, and make a profit. Residents pay this tax on profits from anywhere in the world, while non-residents only pay on profits from things in Spain. Right now, the capital gains tax is 19% for the first 6,000 euros of profit, 21% for profits between 6,000 and 50,000 euros, and 23% for anything above 50,000 euros, but there are ways to lower this tax. If you sell your main home and buy a new one quickly, you might not have to pay any capital gains tax. Also, keeping something valuable for a long time can lower how much tax you pay. Knowing these little details can help you save money when selling valuable things in Spain.